Hi everyone, and welcome to this segment of Real World Real Estate. And in this one, we're going to talk about investing in real estate. And I call this the baby boomer retirement plan only because it was a direct result of some folks who lost quite a bit of their retirement savings when the stock market kind of took a dive, 30 to 40% for some people, which was substantial. That's why I titled it the baby boomer retirement plan, because if you're someone who's like 50 years old and then the market takes a dive and all your money's in there, or most of your money is in there, then you say, oh, well, what do I got to do? Well, in most cases, they continue to work, and their retirement date got moved further into the future. So this is just something that I came up with, which is, again, it's not one of these nothing down, get rich quick kind of thing. This is looking upon real estate purely as an investment and just a vehicle that can be used to get there. And even though it's called the baby boomer retirement plan, I mean, if you're 20 years old or 21 years old, you can get started on this too, and just help build up your net worth. So let's look at the components of it, and it is somewhat common sense. First off, the disclaimers. It's not for everyone. Just like owning real estate, owning investment real estate is not for everyone. Some people just cannot tolerate having tenants or allowing someone else to occupy their property and doing it on their own as opposed to having someone who manages the property for them. So this is not for everyone. Very little is. It's info based on law, taxes, etc. right now when I'm speaking to you. There's constant motion in Washington as to what they're going to take away, what they're going to leave, particularly when it comes to tax laws, what the situation is in the marketplace in terms of interest rates, things like that. So don't say, well, hey, this it can be done because of this. No, real world has to kick in here too. So it's all based on information we have right now. Always use an accountant or other professional whenever you're involved in something, particularly as substantial as buying a large piece or another piece of real estate. I was going to say a large investment like real estate, which it is. I mean, $90,000, $100,000, 75, 80. I mean, it's a big chunk of money. It's a big chunk of money. So always use an accountant, real estate agent if you're not, going to be doing this as a licensed agent. Probably an attorney at some point in terms of, maybe you want to create an LLC to own the properties, just those type of things. But just, as part of a disclaimer, run this by someone who knows, the law and normal accounting practices. So here's how it works. Now, when you watch the cable TVs, they are saying, okay, you go out and you make offers like every day. You make like 5 offers a day or 5 a week or whatever. This is not it. This is a conservative type of approach. And yes, if you can get great financing, good, but if it's funny financing, stay away from it. This is not what we're talking about. The idea is, let's say you're a 50-year-old, okay, because that fits into the whole baby boomer thing. So you're a 50-year-old and you buy one house a year. Now, the formula that you really want to follow is that the payments, PITI, principal, interest, taxes, and insurance, is equal to at least the monthly rent. Remember, this is not a non-involvement type of investment. You are going to be involved. It's real estate. You're renting it out. You're involved. Whether you get someone to do it for you or you do it yourself, there is involvement. So we're not talking about you putting zero money in and doing nothing to it and then 6 months later being a multimillionaire. That's not the case. Slow and steady runs the race in this one. Recommendation is, and again, this falls back to that 50-year-old that we're kind of talking about here, you get a 15-year fixed mortgage. Why? Because you know exactly what your principal and interest payments will be over the next 15 years. And there's another reason. You'll see that in a little bit. Don't buy property that is not in a stable or appreciating area. For this purpose, see, you have to put yourself in the future. You have to think in terms of, okay, I want this to be an area where the rents will increase and the property will increase. So there's an appreciating area. And make it a rentable property. Buying a 5-bedroom colonial in a subdivision, unless it's a really, really, really good deal, but in terms of renting it out, that's a toughie. That's a toughie. Normally 1, 2, 3 bedrooms, you work on that end. The 1 bedroom, obviously, there's not a lot of single family detached homes built that way. And if they are, they tend to probably not be, I don't want to say in an appreciating area, but that's not like a marketable single family home. So if you're buying a condo though, a 1-bedroom condo, now that makes sense, or a 2-bedroom condo, or a 2-bedroom home, or a 3-bedroom home. So make it a rentable property. If it's in that appreciating area, it should not be an issue of renting it out. So here's the example. Let's say you pay $90,000 purchase price for it. And again, I'm just going by some numbers today. If you can get it with 10% down, that's $81,000 mortgage. 15 years at 5% is $640.54. That's just calculated out. Generally, because this is a made-up property, I just said $250 a month, taxes and insurance. Add the two together, that's $890.54. So that means that the rent must be $900 plus, and I rounded it up. Now, this is a very important thing. You don't buy the property and say, I need $900 out of, $900 to, out of it to pay for it, because that's not how the market works. You should know that now, because supply and demand dictates. Meaning, when you purchase the property up front and you figure out, before you purchase the property, you figure out what the monthly payments would be, and then you do a search. You do a CMA for rents, and you say, okay, how much rent will this support? If it comes in at $600 a month, pass. That's why the recommendation is 1 home a year, or 1 house a year, I should say, because you've got plenty of time to look to complete that, if it's just 1 a year, plenty of time, and then just to obviously find the right property. And they're out there. So let's look at the overall. So in 2017, you buy that home. Okay, 2018, buy another home, another house. 19, 20, you get the idea here. So 15 years, you buy 1 home, 1 house a year, 1 property a year for 15 years. Well, by the way, I'm not even speaking, I'm saying single family, but these can be 2 families. This could be whatever you can afford. Now, my approach was this, because it's baby boomer, is the fact that this is money that you put into it. This is not, this is you actually have cash and you make the down payment. Now, as you get further along, you may be willing to borrow against a property, a previously purchased property, to acquire another one. That's totally, up to the individual. Totally up to you if you want to do that. Some people think of it as simply, just like you put money into an IRA or money into a 401k every year, that is, you don't really, you're not looking for a deal on it. You just you take it from your paycheck and you put it there. That's what I'm talking about here. Now, are there better ways of doing it? Of course. Again, you could pyramid this and you can basically leverage it even more. But I'm giving you the straight, simple approach. Okay, so then we come to 2031, and let's now move on. Oh, pardon me, 2032. So 15 years took you to 2031. In 2032, guess what? That home that you purchased in 2017 with a 15-year mortgage, has been paid off, and you own it free and clear. So what you're going to do is in year 2016, now work with me on this, because let's say this is that 50-year-old person. They're now 65, okay? And they're ready to retire. So in year 16, they go to the bank, they go to a lender, and they say to the lender, okay, I want to know how much I can borrow against this property. Now, let's say we paid $90,000 for it. It is now, in 15 years later, it's now worth $150,000, okay? So the lender has, they say, okay, we'll refinance it. Appraisal comes back $150,000. And then you must do the work, and you say, okay, how much? Well, you don't even have to do the work because this has been rented all along. So you know what rent you're getting for that property. You simply say to the lender, how much money can I take out of the house that equals where the payment, the refinance payment, equals the rent that you're getting. Okay? So let's say that now the rents are, $1,500 a month for that particular property. So you say to the lender, what will $1,500 get me? Principal, interest, taxes, and insurance, and total costs. And they say, well, we can give you, your house is free and clear, it's $150,000. We can give you $80,000. And you say, thank you, and you say, write a check. And you refinance that. Now, here's an important thing. The idea is you're going to get another 15-year mortgage on it at this rate, that whatever equals, the rent equals the pity. At present time, and again, this may change in the future, we don't know, but right now, borrowed money is tax-free. So when they give you $80,000, they're giving you $80,000. You don't pay tax on it because it's borrowed money. Now the idea, though, behind that is, and we're not even getting into it, if you recall from our unit on investing in real estate, you get all the other deductions available too. Depreciation, there's a little bit left on it if you do a 20-year here. The taxes, expenses, all of that, because this is an investment property. Okay, so hopefully you understand what I just said. And then guess what? In year 17, you're simply going to, refinance that second house that you purchased because it is now free and clear, using the same approach, and there's your income for that year. So on and so on and so on. That's why we call it the retirement plan. Now, this is simplistic. I mean, I paint a really easy picture of it. And by the way, it's all workable. There's no doubt about it. But see, I'm not talking about, flooded toilets or, bad tenants or changes in the marketplace, anything like that. I'm just giving you a path here that you can follow. And even though it sounds like I'm making this up, no, this has been followed for years by hundreds of thousands of folks out there. There's a really good book called The Millionaire Next Door. And if you get an opportunity to read that, because you find that there's a lot of folks out there who do not flaunt their wealth at all. And in that book, it talks about all the different people and how they made their money, and invariably, whether they made it through real estate or it's simply one of the components of their wealth, there was always real estate. They lived below their means. They were non-obvious. Matter of fact, the most common vehicle that the millionaire next door owns is a Ford F-150 truck. So this is simply a path that you can follow. But look back at the disclaimers, though. Is it for everyone? No. You have to have a temperament to be a landlord. You have to be of the mindset of slow and steady, which is 15 years. You can see how that works. Okay? So, and then you lather, rinse, repeat. 18, you're 18, same thing, 19, whatever. And just keep doing it as long as you really want. And then, frankly, just leave it to your kids. Afterwards, leave them all to your kids, or whatever you want to do with it. So that's it. So that's a nice little real world real estate video, and hope it was worthwhile for you. Take care.